Good afternoon. My name is Tim Nyland, and I'm the Managing Director of Professional Services here at Zacks Investment Research. I'm also one of the portfolio managers and equity strategists who builds and maintains model portfolios here at Zacks. I've been in the business for over 25 years. I'm the designer of the Zacks equity valuation model, along with many of the popular tools featured across our lineup of institutional and advisor services. I want to take a minute and acknowledge that this webinar is being hosted for existing advisor tools and Zacks Research Systems clients and prospects. And I would like to personally thank each of you for taking time out of your busy day to attend this webinar. I also want to thank everyone on the front lines battling this pandemic, as I'm certain that everyone in attendance today has either been directly affected or knows someone affected by the pandemic. Our thoughts and prayers are with all of the first responders and the families that have been impacted by COVID-19. Today, we're going to talk about the earnings certain portfolio and why we need to consider constructing core equity portfolios that are recession-proof. For those of you that were in attendance during our Q4 strategy call that was hosted by myself and John Blank, this is one of the screens that I showed, and I gave a warning, again, back in December of 2019, that we needed to begin to at least think about the next recession. And the chart that I have up on the screen is one that has come out of Advisor Tools. This is also obviously available in the Zacks Research System under the Treasury Yield Curve section. But basically what it's showing is the 10-year, 2-year Treasury yield conversions and how good of an indicator this really is for basically foreshadowing recessions to come. This particular indicator has successfully preceded each of the prior 7 recessions, and you can see why. To be frank, I would have never guessed that the next recession would have been triggered by a global pandemic. At the time of that strategy call, I was preparing everyone to be prepared for at least another recessionary scare at some point within the next 12 to 18 months. This particular chart, along with the events that we're facing today, definitely give warning for the need for us to always be ready for the next black swan event. So I want to spend the rest of the time talking about what it really means to have a recession-proof core equity portfolio. And we're going to make this very, very simple and to the point. I promise not to take too much of your time. If you take a look at the price and earnings chart that I have up on the screen, this particular chart has come out of our institutional platform, the Zacks Research System. And it's showing a price series in blue and a trailing 4 quarters operating earnings line in orange. And the idea is if we can build a portfolio where the underlying members in aggregate can literally plow through recessions virtually unscathed, then we stand a good chance at having a core portfolio that can withstand the next downturn. And if you pay attention to these recessionary periods shaded in gray, you'll see that in the 01 recession, this portfolio actually grew earnings through the 01 recession. And you can see during the latest financial crisis that we did flatline a bit, but we actually plowed through, again, virtually unscathed relative to the remainder of the market. This is the implications of closet indexing equity portfolios to the S&P 500. And regardless of how you slice and dice a portfolio on the equity side, they all seem to be somewhat correlated to the S&P 500. What I'm showing you on the screen right now is another price and earnings chart out of the Zacks Research System, but this time it actually shows the S&P 500 index. And the reason I'm showing this to you, the scaling is actually a little bit distorted because the trough in the 08 recession was actually much larger than it appears on the screen, just simply due to the log scale nature of the chart. But the idea is I want to show everyone how exposed your clients really are on the equity side as we roll through these recessions. And you can see that if earnings are in fact the lifeblood of equity valuation, then one would think that if we could protect the portfolio's underlying corporate earnings stream during a recession, that perhaps from an equity valuation perspective, we would be in better shape. And you can see here what happens to the S&P 500 earnings. They in fact trough. These earnings troughs in recessions lead to rapid equity valuation declines. This is the actual iShares ETF bottom-up reconstructed in the Zacks research system as a composite. This is the best way to actually look at the underlying fundamental and growth trends related to any ETF portfolio benchmark or whatever you're trying to analyze. So what we're looking at here is a 25-year least squares growth trend to trailing 4 quarters earnings. Again, each of these orange dots representing the prior trailing 4 quarters earnings, so it removes any seasonality. And you can see that this growth rate on a 25-year least squares basis is actually 4.63%, and it's very cyclical. And you can see the depth of that 08 trough versus what happened in 01. And you can see obviously precipitous declines in equity valuations in both of those recessions. Let's compare that to what we call the earnings certain portfolio and its 25-year least squares growth trend. And you can see by virtue of managing the underlying equity portfolios such that the underlying company's earnings go through these recessionary periods unscathed, you end up with a steady 13.92% EPS trailing 4-quarter growth rate. Okay? So the idea here is that earnings are the lifeblood of equity valuations. So how does this, in fact, translate to performance? So if we take a look at that same 25-year period and we look at the performance of the earnings certain portfolio relative to the S&P 500, you can see that we pick up significant alpha during the recessionary troughs. So the iShares IVV performance you can see as the red line, and you can see how deep these valuation ruts become in recessions. And you can also see how the earnings certain proxy or the portfolio itself holds up and just continues to outperform the broader benchmark. The relationship is even more visible if we shorten the time frame just by 5 years. Now we're looking at 20 years, and I've actually drawn some lines here so you can kind of see the differences. Again, material outperformance across all periods, especially throughout these recessionary troughs. On an equal weighted basis, we're looking at just shy of 6 times cumulative returns over the S&P 500. A lot of advisors give credence to Noble, which is the S&P 500 Dividend Aristocrat ETF. And it is obviously a solid dividend aristocrat ETF, but it also suffers from the same drag in performance as the broader benchmark. And you can see that over 20 years, we even outperform the Noble ETF by about 2.5 times on a cumulative basis. If we change the picture a little bit to incorporate total return performance, the prior chart was price return. If we change the scope to look at total return, acknowledging that Noble's dividend yield is roughly 1.5 to 2 times the earnings certain portfolio's dividend yield, the performance then contracts down to about 1.75 times outperformance. So still outperforming, but just a little bit less than price return. Many of you are probably wondering, well, how has it done to date since the coronavirus has struck? And again, the earnings certain portfolio versus the IVV, we're up about 4%. This was through March 30th when I put together the deck. So this would be from the initial sell-off, which I believe happened right around February 20th through March 30th. we've been trending anywhere between 2.5 to roughly 4% beat on a daily basis, cumulative from that time frame. This is the performance of the earnings certain portfolio relative to Noble over that same time frame. And again, this is price return, not total return, since we're dealing with such a short time frame, and we're looking at about a 4.5% beat. So what besides earning stability is driving the outperformance? The idea with the Zacks earnings certain proxy, or the earnings certain portfolio, is that there are no tilt sectors present in the earnings certain portfolio. And over the course of the next several slides, we're going to do a little bit of a deeper dive into exactly how it was constructed and how it's maintained. There are no interest rate sensitive sectors and industries such as financials, commodities, precious metals, energies, or utilities. And at a first glance, many of you are probably thinking, well, this is a problem. And it's not, because the idea is that you use this as a core equity portfolio and you decide amongst yourselves where to apply these tilts. So if we believe that the yield curve is going to steepen, rates are going to start rising, then you start building in a little bit of an exposure to financials. You've already got an edge over the broader benchmark, so applying a financials tilt to that will just magnify your alpha relative to the benchmark. So this is what the sector allocation currently looks like for the earnings certain portfolio. Notice the heavy weight in the consumer names, heavy weight in healthcare relative to the tech heavy weight in the S&P 500. In the next slide, I've actually got what the sector allocation looks like relative to the S&P 500. And you can see that tech is about a 50% underweight. Consumer names are literally 2.3 times the benchmark. As a matter of fact, for probably 20 years, the earnings certain portfolio was a 50 stock portfolio. And after the Great Recession, consumer names became such a massive weight in the portfolio that I actually had to expand the membership by 25 names to bring that weight down. And that's the only time I've ever managed the earnings certain portfolio to sector allocation. Otherwise, it's not managed at all relative to sector allocation. Okay. Just to show this again, we want to talk now about how the portfolio is constructed, how it's maintained. It really is a remarkable portfolio. And one of the most remarkable things about the portfolio is that it's not managed to performance. And that is, in and of itself, one of the reasons why it's so successful. We're not chasing performance. We're chasing rock solid earning stability, among other things we'll talk about now. The original portfolio was constructed over 25 years ago. This was a project that was born out of B of A Securities by the former DOR there. I was actually one of the founding members of a firm that he started back in the early 1990s. And the project was, at the time, we needed to basically build a market basket of securities where we could forecast F12M earnings with 95% accuracy. The idea was, at the time, if we could do that with 95% accuracy and we could actually come up with a fulcrum point for earnings, in other words, an actual F12M point 12 months forward, and we had earnings stability for the prior 15 to 20 years such that we could actually assume a constant growth rate, then we could actually measure fund flows on a weekly basis between the equity basket of securities and the risk-free basket of securities, in this case, 10-year treasuries. And we could use this information to actually solve for a real market implied equity risk premium, which is so critical as a macro factor in equity valuations. So we did this. I continue to do this each week for Zacks. I did it on Monday. And this is one of the key inputs to the Zacks equity valuation model on the Zacks Research System platform, our institutional platform. Again, in bold down at the bottom of the slide, the key takeaway here is that the earnings certain portfolio was and is still to this day not managed to performance. Performance is simply a byproduct of this process. Okay, as a result, turnover is extremely low. Relatively speaking to some of the broader indices, which are supposed to be passive, they're very actively managed. Many members of the portfolio itself are literally original members from 25 plus years ago. As a matter of fact, in 2019, there were no changes in membership to the Earnings Certain portfolio. There are currently 2 members that I have under watch, and I am literally in the middle of doing the Q1 2020 rebalance as we speak. The Earnings Certain portfolio is a list of probably the most boring companies you can imagine. The beta collectively of the Earnings Certain portfolio is a whopping 0.8. The boring portfolio. Again, the idea is here that this is a core equity portfolio that you can call your own. A good analogy I like to use is, we're delivering you a chocolate cake, just the cake. Then you decide how you're going to decorate it. You put your frosting on. We can help you with that. So this is literally a portfolio of 75 legendary, mature, dividend aristocratic industrial names, again, whose earnings performance has literally withstood the test of time through macroeconomic hardship. The coronavirus downturn that we're facing today is certainly going to be a test for the Earnings Certain portfolio, but I'm confident that we will prevail. Keep in mind as we're going through this process of the fact that these are the most boring companies you could imagine. There is no Apple. There is no Facebook. There's no Microsoft. There's no Netflix. There's no Amazon. There's no Google, no IPOs, no pot stocks, no Teslas, none of that. Okay? So again, the takeaway here is if you invest in the Earnings Certain portfolio, you've already got an edge on the market. If you pick 1 or 2 conviction stocks to apply a tilt or use ETFs to apply your tilts, you have something that you can call your own and you have a market-winning strategy. The dividend yield collectively outpaces the current 10-year treasury by roughly more than 2x. The model portfolio itself is meant to be implemented as an equal dollar-weighted portfolio, and all I do is recommend that you rebalance a minimum of 1 time per year. And the reason for that, you can rebalance quarterly if you want. I've been managing this portfolio so long, and I know each of these names so well that they tend, when the valuations of the individual names will tend to contract for a time period. Sometimes, forward multiples can contract for upwards of 1 year, and like a rubber band, valuations will get stretched so thin, then all of a sudden the stock's forward multiple will begin to expand in terms of price appreciation or equity valuation increase. And that period of time tends to run for about 9 months. So quarterly rebalancing isn't necessary. I just recommend a minimum of 1 time a year. This is an ultra long-term buy and hold portfolio. So timing is less an issue for making entry points. But I do always recommend buying in on any weakness, again, as that valuation multiple begins to contract over time and that valuation rubber band, if you will, begins to stretch. That's a good time to couple that period with the Zacks equity rank to determine when estimate forecasts might be increasing and kind of, beat the rest of the market to that forward multiple expansion. So again, just to summarize before we get into construction, the Earnings Certain portfolio is a collection of those boring industrial earnings stable companies. 20 years or more of financial statement history is what I really require to be a member of this group. There needs to be no history of accounting irregularities or other events that would otherwise distort the financials. And again, the fact that most of these end up being dividend aristocratic companies with strong balance sheets. So again, constructed over 25 years ago, it's actually distilled through 2 other portfolios. Everyone has access to all of this in advisor tools. The Earnings Certain portfolio itself does require an entitlement. We'll talk a little bit more about that in a minute. Starting with the S&P 500, again, more than 25 years ago, we stripped out all of the tilt sector companies that I mentioned, and also those with any financial irregularities. The resulting list at that time was 250 or so names. We added back 150 like names to create a large universe of roughly 400 names called the Standard Industrial Proxy. Okay? If you think for a minute that we have a good pulse of the U.S. industrial economy with 400 names X the tilt sectors, if we evenly split the 400 names into growth and cyclical names, in other words, more or less rank the 400 names by earnings stability, 200 names were placed into what we call a portfolio named the growth portfolio, and the other 200 were placed into a portfolio named the cyclical portfolio. And the way it works is that the 75 most earnings stable names from the original universe of 200 growth companies are literally what makes up the earnings certain portfolio. So that's how it was constructed, and to this day, I don't just pick and choose companies that come in and out of the earnings certain portfolio. The companies had to have already been in the standard industrial proxy and have had to have flown through to the growth portfolio before I can consider them as a member for the earnings certain portfolio. It's a very, very disciplined approach to ensuring that turnover remains low and that we don't result in knee-jerk changes to the underlying portfolio, and it keeps you from being tempted to want to chase performance. So where do I find them in Advisor Tools? For Advisor Tools users that are entitled to the equity model portfolios that I'm putting my cursor over right here on the screen, it's under Zacks Research. You'll see equity model portfolios if you have the entitlement. If you do not have the entitlement, please reach out to your Advisor Tools account manager. You can contact our 800 number or the salesperson that you have a relationship with already, and they can assist you. This is basically where it's located. You'll also get access to the Zacks Focus list, which is another 50 names that includes the tilt sectors that will allow you to apply individual equity conviction tilts. And we'll talk a little bit more about that here in a coming slide. The equity select lists in Advisor Tools are currently entitled for all Advisor Tools users, and you can see where I manage the standard industrial proxy, the growth proxy, and the cyclical proxy. Notice that the growth proxy and the cyclical proxy are 200 names. They both of those lists roll up into the standard industrial proxy. The 75 most earnings stable names are basically what constitutes the earnings certain proxy. Where do I find them in the Zacks Research System? If you're a Research System subscriber, all you have to do is know the ticker symbols, and to get access to those, you just click on the magnifying glass, go into Universe List as Custom Composites, and scroll all the way to the bottom, and you'll see them all there. So how do you call this methodology your own? Just to recap, right, there's no exposure to the tilt sectors. So to the extent you have a strategist in your own firm, to the extent you want to utilize our monthly strategy piece called the Monthly Investing Update and Asset Allocation, this is a piece that our chief economist and head strategist at Zacks, John Blank, puts together once a month. It's a remarkable piece. He does a really good job, and it basically provides a table towards the back of the publication that basically is a roadmap to which sectors are more likely to outperform and which sectors and industries are more likely to underperform. And you can use ETFs to more or less apply tilts that way. Again, there's no Apple, there's no Facebook, there's no Microsoft, there's none of these names, no Teslas, no IPOs. So if you have conviction bets that you or your firm wants to make or your clients want to make, again, this is a way to apply very small tilts that can add a tremendous amount of alpha. And so that pretty much takes us through use case one. Use case 2 is, look, if you're not interested in utilizing the entire earnings certain portfolio of 75 names, you can combine that list with the 50 stocks that are in the Zacks focus list. Again, you'll get entitlements to both lists as a Zacks equity model portfolio subscriber under Advisor Tools. And you'll then have a list of 125 names that are reliable performing stocks and the ones that we feel will outperform in the U.S. equity market. So again, the idea is, if you like the idea of the earnings certain portfolio, but you want to add financials exposure, right now, if you were to open up the focus list in your Advisor Tools subscription, you'll see that we have 3 conviction bets for the banking sector, and you can apply any of those names that you want as a tilt, if that's what you'd like to do. I can be reached directly. I would also like to emphasize that any of our US-based sales and support team members can speak to the earnings certain portfolio as well as the focus list. You can reach out to me directly, or you can request a meeting through your sales or account management representative. I'm more than happy to speak with anybody about this. And you can also reach out to your sales and account management representative to receive a copy of this presentation deck. That's all I had for today. I'd like to thank everyone for their time and attention, and thank you all for your continued support of Zacks.